Chapter 3 Money and Banking Question Answers from Class 12, Subject Economics, Book Introductory Macroeconomics. Exercises Question 1 What is a barter system? What are its drawbacks? Answer In ancient times, the barter system was used to exchange things. It was a method of exchanging one commodity, product, or set of goods for another. For example, if a person has 1 kg of sugar and wants 1 kg of jaggery in trade, he can do so if someone else is prepared to exchange sugar for jaggery. A commodity for commodity exchange was the name given to this activity. It was also supplanted by the monetary system. The following are some of the disadvantages of the barter system. First, double coincidence of wants. It is one of the assumptions that led to the downfall of the barter system. The double coincidence of wants indicates that two individuals will only exchange commodities and services if they both require the goods of the other. Second, indivisibility of goods. This refers to another significant disadvantage of the barter system. In the event of items that lose their utility when divided into components, the barter system of exchange was not applicable. Third, common measure of value, one of the most significant causes for the barter system's collapse. Because there is no universal measure of worth in the barter system, determining a set ratio for exchanging commodities and services is problematic. Fourth, store of value refers to one of the reasons for the barter system's collapse. In the barter system, value is stored in the form of commodities including cereal grains and livestock. Question 2. What are the main functions of money? How does money overcome the shortcomings of a barter system? Answer. Money had the following functions. A. Primary. B. Secondary. The primary functions of money are as follows. A. Money served as the medium of exchange and facilitated buying and selling of goods and services. The exchange was simple and could be scaled accordingly. B. Money served as a common source of value for goods. In the barter system, it was not possible to determine the value of an item, but money made it possible to value goods. So, it served as a measure of value. The secondary functions of money are as follows. A. Money could be easily stored as compared to the goods that were received in exchange in a barter system. So, it acted as a store of value. B. Deferred payments have become much easier with the introduction of money. Loans can be repaid in a much better way as compared to the barter system. It overcame the following shortcomings of the barter system. A. It eliminated the double coincidence of wants, which was the most important shortcoming of the barter system. B. It overcame the problem of the valuation of goods. In the barter system, goods exchanged were not proper in value with each other. C. It facilitated contractual payments and future payments that were not possible in the barter system. D. It was easy to store money than perishable goods as was provided in the barter system. Question 3. What is transaction demand for money? How is it related to the value of transactions over a specified period of time? Answer. Transaction demand for money refers to the demand for money to carry out everyday transactions. It's the amount of money people and businesses need to facilitate purchases of goods and services. In essence, it's the money held for spending purposes. Relationship to the value of transactions. The transaction demand for money is directly and positively related to the value of transactions over a specified period of time. Here's how. Higher value of transaction is equal to higher transaction demand. If the total value of goods and services being exchanged in an economy increases, people and businesses will need more money to complete those transactions. For example, if there's a surge in retail sales or if businesses are investing heavily in new equipment, the demand for money to facilitate these transactions will rise. Lower value of transaction is equals to lower transaction demand. Conversely, if the value of transactions decreases, the demand for money for transaction purposes will also decrease. For instance, during an economic downturn, when spending slows down, people and businesses will hold less money for transactions. Question 4. What are the alternative definitions of money supply in India? Answer. There are four definitions of money supply in India, which are M1, M2, M3 and M4. These are arranged in descending order of liquidity. Therefore, M1 has the highest liquidity and M4 has the least. Now, M1 is equals to C plus DD plus OD, where C is the currency held by the public of the nation, DD is the demand deposit present in banks, OD is the other type of deposit present in the RBI. Also, M2 is equals to M1 plus savings done by people in post offices. M3 is equals to M1 plus net time deposits of the banks. M4 is equals to M3 plus total deposit held in post offices excluding NSC, that is National Savings Certificate. Question 5. What is a legal tender? What is flat money? Answer. A legal tender is a medium of payment which is accepted by a legal system for making payments in order to meet the financial obligation. It is a form of payment that is recognized by the government in order to pay for any kind of debt or the financial obligation. For example, the notes and coins that are in use in India are legal tender money. Flat money is a currency that lacks value in itself unless declared legal tender by the government. It acts as money which is backed by the government. It can be used to pay for the purchase of goods and services. What is high powered money? Answer. High powered money is referred to as the currency which has been issued by the government or the Reserve Bank of India. A major portion of this currency is stored as reserves in Reserve Bank, while some part of it is kept with the public. It can be represented by the equation H is equals to C plus R, where H stands for high powered money, C stands for currency that is with the public, includes cash and coins. R stands for deposits and RBI with bank and government. Question 7. Explain the functions of a commercial bank. Answer. A commercial bank is a type of financial organization that handles all transactions involving the deposit and withdrawal of money for the public, as well as the provision of loans for investment purposes and other similar activities. A. Accept deposits. Deposits are accepted at the bank in the form of savings, current and fixed deposits. Surplus funds received from businesses and people are lent to meet the short-term needs of commercial operations. B. Credit cash. When a customer receives credit or a loan, they do not receive liquid cash. The customer's bank account is opened first and then the funds are sent to the account. The bank is able to manufacture money through this technique. C. Provides loan and advances. Another important duty of this bank is to provide loans and advances to entrepreneurs and business persons, as well as collect interest. It is the most important source of earnings for any bank. D. Overdraft facility. This is a loan offered to a customer in exchange for keeping their current account open and allowing them to overdraw up to a certain limit. E. Discounting bills of exchange. A discount bill of exchange is a written agreement that acknowledges the sum of money to be paid for products acquired at a future date. A commercial bank's discounting strategy can also be used to clear the payment before the quoted period. F. Locker facilities. Customers can use a bank's locker facilities to store their valuables or papers discreetly. This service is charged at least once a year by the banks. G. Purchasing and selling securities. The bank provides you with the option of buying and selling securities. Question 8. What is money multiplier? How will you determine its value? What ratios play an important role in the determination of the value of the money multiplier? Answer. The money multiplier is the amount of money generated by banks for every dollar of reserves. The amount of deposits that the Federal Reserve must hold rather than lend is referred to as a reserve. In an economy, it is the ratio of money stock to high powered money stock. In an economy, the money multiplier is the ratio of the stock of money to the stock of high powered money. MM is equals to M divided by H, where MM is the money multiplier. M is equals to stock of money H is equals to high powered money. The value of multiplier is always more than 1 and it can be calculated as follows. M is equals to C plus DD is equals to 1 plus CDR DD, where M is equals to money supply, C is equals to currency held by people, CDR is equals to currency deposit ratio, DD is equals to demand deposits. Next, high powered money is equals to currency plus reserve money. H is equals to C plus R, CDRD plus RDRD, D common, CDR plus RDR. So, M divided by H is equals to 1 plus CDR divided by CDR plus RDR, which is greater than 1. When calculating the money multiplier, the reserve deposit ratio and currency deposit ratio are key factors to consider. The CDR is the proportion of money held by the general population compared to money held in bank deposits. The RDR is the percentage of total deposits held as reserve by commercial banks. Question 9. What are the instruments of monetary policy of the RBI? Answer. The central bank's policy on the use of monetary tools within its authority to fulfill the Act's goal is referred to as monetary policy. The Reserve Bank of India (RBI) is charged for implementing monetary policy in India. The Reserve Bank of India Act 1934 expressly mandates this obligation. The instruments of monetary policy of the RBI are as follows. First, quantitative measures, varying reserve ratios. First, cash reserve ratio (CRR). It is a portion of a bank's total deposits that the Reserve Bank of India requires to be kept with the latter as liquid cash reserves. Second, statutory liquidity ratio (SLS). It is essentially the reserve requirement that banks must maintain before extending credit to customers. It is essentially the reserve requirement that banks must maintain before extending credit to customers. Next, bank rate. The interest rate charged by a nation's central bank to its domestic banks in order for them to borrow money is referred to as its bank rate. The interest rates charged by central banks are meant to stabilize the economy. Next, high powered money. It is the money created by the RBI and the government, in which the public holds the currency and the banks hold the cash reserves. It differs from money for that money consists of demand deposits, whereas cash reserves serve as a foundation for creating demand deposits. Second, qualitative measures. Open market operation. It refers to the central bank selling and purchase of securities on the open market to and from commercial bank or the general public. Bank rate policy. It refers to the central bank's manipulation of the discount rate in order to influence the economy's credit condition. Next, sterilization by RBI. The RBI's market based strategy in neutralizing a portion or the whole monetary impact of foreign inflows is known as sterilizing. Next, moral suasion. The RBI uses this strategy to persuade commercial banks to assist in regulating the money supply in the economy. The Reserve Bank of India (RBI) is a key player in the management of external stocks. Assume a foreigner decides to put money into Indian bonds. The foreign currency is then exchanged into Indian rupees by the bond seller at a commercial bank. The same commercial bank deposits money in the RBI, increasing assets and liabilities on the balance sheet, but the overall reserves of the commercial bank remain unaltered. Question 10. Do you consider a commercial bank creator of money in the economy? Answer. Yes. Commercial banks play a significant role in the economy as money creators. They are able to generate credit by way of demand deposits. Demand deposits provide credit in excess of the initial deposits. As a result, banks build credit by making loans. Using a bank XYZ as an example, the process of money production can be discussed. A depositor makes a rupees 20,000 deposit in his savings account, which the bank treats as a demand deposit. Based on the pre-assumption that not all clients will withdraw their deposits on the same day, the bank keeps a minimum cash reserve of 10% of demand deposits. It extends credit to other consumers for the remaining amount of rupees 18,000. This generates more deposits for the XYZ bank. As a result, the credit multiplier is equals to 1 divided by CRP is equals to 1 divided by 10% is equals to 10. The amount of credit multiplier will enhance the money supply. Question 11. What role of RBI is known as lender of last resort? Answer. When a commercial bank is faced with a financial crisis and is unable to secure funds from other sources, the central bank steps in as a lender of last resort, providing financial assistance in the form of credit. The central bank's role saves the commercial bank from failure. As a result, the central bank acts as a guarantor for commercial banks, ensuring that the financial system in the economy is sound and healthy. Friends, we have completed all the question answers from chapter 3, Money and Banking. If you like the video, kindly like it and share it with your friends. You can join membership of the channel for donations and early access to new videos. We will meet in the next video. Thank you for watching.